This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hi, this is Louis Llanos with WealthNet Investments. Today I want to talk a little bit about being retire ready. This is something that is a big push that we're doing at my firm because there's so many people out there who are really trying to get that financial independence set up, and they're really trying to get in a situation where they know they have that financial security that they're looking for. Now, as an investment manager, my goal is to try to help people get to that level. I want to talk a little bit about something I got in the mail today. I got this thing in the mail. It says Retirement Planning Today, an educational course for adults age 50 to 70. Now, we looked at our client base, and our client base, almost half of our clients are between the ages of 55 and 64. And many of them are financially independent, and many of them are getting really close to it. So they're really trying to, it's almost like flying an airplane, and you're landing the airplane, and you want to make sure that you land that thing safe, because you have to kind of grab it. You can't be on autopilot. You got to grab a hold of the reins there and bring it in safely. And that's a big part of what we're doing. And the reason why I want to really do a series on this whole concept of retire ready is that the need is so great, and because doing it is actually more of an art than science. There's a scientific element to it, but there's a lot of science to it. As I was going through this thing, it looks like this is a salesperson that's trying to sell, various products. And I want to just kind of do away with this whole sales concept and really talk about the nuts and bolts of really getting the job done. In other words, how do we actually do this without all of the noise that you're getting from the financial services industry? You've got all these different kind of advisors, so to speak, out there. You've got brokers. Many of the people that you see as so-called advisors are really brokers or salespeople, or they may be insurance agents, and they get focused on selling insurance. And it's like anything else. If you are a hammer, the only thing that you see is a nail. Everything's a nail that you need to kind of pound in. That's what you think is the right thing. So if the only thing I sell is insurance, then I'm going to want to sell you annuities, life insurance, and all that to do everything, college, retirement. And if I'm only a stockbroker, or if I work for a firm that has a lot of proprietary products, like a large brokerage firm, then, that's the kind of tool that I'm always going to use. Now, and I'm not trying to tune our own horn, but I will a little bit. We are financial advisors that are independent. So what basically our goal is to be independent and unbiased. We're fiduciaries. We're registered investment advisors. So we don't have a bone to pick about what to do, what products to use, what investment strategies to use. We just want to get the job done well, because when we win, you win, you win, we win. We get paid more when you make more money, etc. But the reason why I bring that up is only because there's so much confusion out there about who is who in this industry. All right, so I want to talk a little bit about this retirement planning today. So these are the kinds of things that people are getting in the mail. And what they say is, we're going to help you determine the amount of money you need. We're going to help you look at your debt, and we're going to help you with IRA conversions and all that stuff. All of these things are really, really important. The number one thing, though, however, in becoming retire ready is really your personal actions of saving and the investment strategy that you have and how you actually emotionally deal with your investments. So obviously, if you've put together a significant amount of wealth, which most of our clients have, it's really important to not just make money, but you got to keep that money. And that's super important. So when the markets get rough, like the fourth quarter of this last year, obviously we need to keep that money going. So a big part, just so you know, I've been in this business for 26 years, and I've been able to successfully land this airplane for many different people who are, rich CEOs all the way down to mom and pop, normal everyday people who are trying to get this done. And so there's two parts to this whole thing. There's this investment management part, and then there's the planning part. Now, one of the problems that you see is out in the marketplace, people get confused as to what they're paying for. They'll pay somebody who's really a financial planner to do investment management. They're planning, and then they're doing investment management as well. And then they're charging fee upon fee upon fee. In fact, one of the things that we did was in the system that we do our billing and reporting, where we calculate all of our fees and calculate all the performance, that's done by a third party. they actually look at billions and billions of dollars of people that are in the investment management and advisory system that are in their platform. And they tell us, like, scorecard wise, how are we performing and what do our fees look like relative to the marketplace. And I'm actually really proud to say that our performance was in the top 13% of all the advisors last year and all the money managers in the system. And also, I'm proud to say that our fees were 25 basis points less than everybody else. And why? How are we able to do that? Well, I'll tell you, the big way that we're able to do that is we don't stack fees upon fees. We go directly to the marketplace. We look at individual stocks and bonds and we buy them directly, because what's happening with most people, and this really is something that I see over and over again, and I'm going to give you another example. People are going and they go to these advisors, they're planners who are really not money managers. And what they're doing is they're saying, here, Mr. Finkelstein or whoever you are, let's take a look at your situation. And now what we're going to do is we're going to do what's called a wrap program in a mutual fund wrap, where we're going to charge fees on the mutual funds themselves. They charge their fee, and then we're going to charge our fee on top of that fee. And then maybe the custodian charges another fee, and they just keep adding and adding and adding. So our goal is to use custodians that are discount firms. The big names, I'm not going to mention the names, but the big names that you know about. But they charge us a low fee for us to trade, right? When we trade for you. So we pay a fixed trade fee, and then we are buying securities directly, so we don't have that other layer of fee. Now, sometimes we might have a packaged instrument like an exchange-traded fund or even a mutual fund, but we always look at those fees. That's how come when you look at fees to end, our fees in the system that we are tracked in is lower, 25 basis points lower than everybody else. That's one way that we're able to get the performance better. And our performance, it's not just about fees, because you can have higher fees, and if you have a good strategy, you can make money. Now, in the last year, it was tough to make money in general for everybody. It was a tough year, unless you were like a short, you do a lot of shorting and things like that. So, but over the long run, it really does make a difference. Fees do make a difference. But also makes even more of a difference, in my opinion, is risk management. Because when you have an instrument, when you got a portfolio that goes down by 50%, obviously you got to go up 100% just to break even. And how often do you see returns go up 100%? Well, you don't see that happen very often. So it's really important to us that we keep those drawdowns, the drops in performance, not being so large. And, if you I go back through my career over the 2 decades plus, almost 3 decades, there's been a lot of big bear markets. And the thing that you learn from every single bear market is how to deal with them, how to lighten up when the risks are starting to accumulate, and then how to add more investment when the values are good, when things are down, and to look at not only the fundamentals, but also the technicals. All of that stuff is really, really important if you're going to be retire ready, if you will. But you got to do the planning as well. So now, but what are you paying for? Are you paying for the planning, or are you paying for the investment management? So I would say that those are two separate things. So at our firm, what we do is we have two different models. I mean, if we're just managing money, here's our managed money model. If we're doing planning, there's a lot more labor involved and a lot more things that we're going to be doing for you. We're going to be looking in depth about what your situation is, and then diving in and saying, okay, now here's what we need to be doing. So, but let me just go through this list really quick. This is a course that this salesperson has. And he talks about, a lot. It sounds really good. Life planning, expenses and needs, roadblocks and mistakes. And these are all very, very important things. But the problem is, at the end of the day with this, is that can you really get financial independence from a single advisor? I'm going to say the answer to that is no. And the reason why is there's more to it than just the advisor. You know what else there's a lot to do with is the individual themselves. An individual has to follow the plan and have the discipline throughout the process to actually follow through. The number one problem that I have seen in my career is people not following through. And whenever the markets get rocky, we get very emotional, right? So the first step is to get your risk profile totally in line. And if you've read my book, The Financial Freedom Blueprint, there's a section there on just getting your risk profile together. Because if you don't get that risk profile together right from the get-go, then what happens is that you'll make bad mistakes along the way. And people have this natural tendency that when the volatility is low and things are going up, that I want to have my money more aggressive. And then as soon as you have that first sell-off, then all of a sudden people want to get more conservative. And that's actually not what you should be doing. It's really kind of the opposite. It's really related to valuation and being more steady. And I want to use an analogy. My brother-in-law likes to cycle, and he's really into it. And he's an ex-military guy, retired. And one of the things that he said to me one day made so much sense, and I like to use this as an analogy for investing. He was talking about, when you're pedaling as a cyclist, if you just have a steady pressure on what you're doing, whether you're going up the hill, when you're pedaling, whether you're going up the hill or whether you're going down the hill, if you just keep it steady, you actually maximize your efficiency and get the most output per unit of effort, per unit of pressure. And you know what? That is the same with investing. When there's times when you need to be pressing on the gas pedal, it seems like it's a little bit harder or softer. People want to be sporadic about how they're pressing and pulling back on the gas pedal. That can, if you're perfect, then you can really go back in hindsight and say, wow, that worked really well. But in reality, people cannot perfectly time those pedals. So it needs to be more of a steady volatility. So there's times when volatility is more compressed and you just keep that pressure the same. When volatility gets increased, you keep the pressure the same. Your exposures might be lower. And what winds up happening is per unit of capital, you wind up getting more per unit of return. And it's almost like physics. So getting Retire Ready is super important. Now I'm going to be working, this is not an official rollout of the Retire Ready program that we're doing, which by the way we are doing, but there'll be some stuff on that. And it's going to be really tying in investment management, that not more technical about which stock, which bond, trading or anything like that, or investing, more about the overall investment strategy combined with the planning, because that's what people need to hear right now, actually. There's a lot of stuff and a lot of noise out there about trading, and that's important stuff, but I think what's even more important than that is this. What is the strategy, and how are you going to actually monitor yourself and monitor your own actions to actually create a great outcome and to have that financial security? So that's all for now. I don't have much time left over on this particular video, but be watching out for that Retire Ready introduction that I'm going to be putting out. It's going to be very interesting. I think a lot of people, individual investors, will find this interesting. My friends that are money managers, maybe this will bore them, or maybe that's not interesting to them, but individual investors and more individual investors are really kind of watching what I'm doing, and we manage money for individual investors. So that's a big part of our focus. But I really want to encourage you, if you are an individual investor and you really want to retire ready, if you will, to watch those videos. Okay, this is Louis Llanes with WealthNet Investments signing off. Happy trading and investing.
If you like this information, be sure to subscribe and follow us on Twitter and Facebook. The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals.